So tonight we got quite the list of items to talk about. I want to talk a lot about options. I want to talk a lot about swing trading. I want to talk a lot about scaling in and free share conversions. A lengthy class, but I think it'll be well worth it, to be quite honest with you. First and foremost, we've already had some lessons, and if you haven't seen them, check out my lesson library in the member area of the website about indicators, all that good stuff, planning needs, you name it, we've talked about it. And we want to talk tonight a little bit about, setting up your chart in a way that plans your trade. You guys have seen me many a times talking about, and I'm going to switch over to another chart really quick as well. But you guys have seen me in the past, talk about, kind of charts, getting your charts working for you. Real simple, ways. You should be active with your charts. You should be actively, doctoring up your charts and your trades to plan your trades. You guys have seen me do that with charts constantly. On intraday charts, daily charts, ways I like to keep things kind of well planned the whole way. It's not really an OCD thing. It's not that at all. What it really comes down to is wanting to make the best trade decisions possible. So definitely a good idea to constantly keep up with your charts and have plans with your trading that limit the amount of risk you may be trading on. One thing we haven't talked a lot about is swing points. Swing points are a pretty simple thing, really, would be the high area in a trading range. You see a swing high up in here. The swing low would be the lows in that trading range. These are generally a good tool to gauge pullbacks for scaling. Many times you'll get better movement throughout the trade by using other methods such as channels and not. But when scaling into a trade, swing points can be a very consistent way to enter and exit. Now, some people tell me all the time that, I can't really scale in. I'm not dealing with that much money. I'm going to go back to what I've said before, where the amount of money you're dealing with isn't as essential as the proper trade tools used in trading. Now, if you're only trading $500 at a time as a maximum trade position, you're not really going to scale into a trade like AMD. So you understand your risk-reward or your risk-reward ratio before entering into something like that. But trading a cheap stock like Intech, with Intech, you could very easily scale in, $250 at a time to limit your risk in the trade, and still trying to get, lowest price possible, but hey, it could actually bounce here, so We'll see where we can get in at type of thing. So pretty essential type things to be teaching and using during your planning. Now, when we talk about the trade plan in general, whether it be options trading, whether it be common stock trading, just generally speaking with the swing trade, you've got to be patient. Goldman Sachs is a good company. Goldman is a good company. There's no doubt about that. Goldman Sachs repeatedly goes up. It repeatedly goes down. It goes up. It repeatedly goes. Pretty simple deal. A lot of people, they want to, whether it be a stock like Goldman Sachs or some penny stock reading about on an iHub board, a lot of people just want to go, ooh, ooh, ooh. The best swing trades you're going to have are in identifying the trade system the chart is best fitting and being patient enough to wait for those times to make your entries. Real simple to do. It is very, very simple to remain patient. It is really easy to chase things and then end up losing trade only to see it run up on you again because you're impatient, and your impatience is what caused you to chase it. The impatience is what caused you to sell out quick at a small loss. And in reality, if it's trading in a channel, so long as it's holding within that channel, there's high 158 range. And really what you kind of look at here is, okay, at that time, it was only about a third of the way up the channel. You're kind of halfway through that channel point. Once you get past that halfway point of that channel, it's no longer really in the buy category. No longer in the buy category. It's a real simple thing when it comes to trading, that every stock out there will pull back. I don't care what idiot pumper is trying to get you to believe that any stock is going to go straight to the moon and never pull back. Every stock out there will go up and will come down. Good stocks will make higher lows. Bad stocks will make lower lows. What kind of stocks do we want to find for our long positions? We want to find those higher lows, right? There's a lot of times on charts out there that you hear people ask me in chat all the time. It's like, hey, what was that one piece of crap today? NEM. It's a gold stock that's making lower lows. People ask me all the time about stocks that are just completely falling apart. Wait until it starts to make a higher low. One thing I can tell you is that it won't go straight to 50 bucks without a series of ups and downs. You want to trade in a way that you're okay to let it run and then let it see if it'll make a higher low. We'll look at a couple recent trades we've done that on. RVLT. let RVLT fall. We made a small little trade here, but on the confirmation of a higher low, we began trading it bigger. Actually, it was here on the confirmation of a higher low that we began for a little day trade here. During this time, when you're constantly trying to go, ooh, can I catch the bottom? Ooh, catch the bottom. Pure risk. Pure risk. But on the confirmation of a higher low, after a fall, as you can see, our VLT jumped, it pulled back, gave us a higher low. And we were in for this run. I'll go over to Intech, a little penny stock. Day in and day out, you can get on iHub, and it always seems that when it's at its highest is when all the iHub idiots are telling, oh, this is so great, look at the day last time when it made the 52. You definitely didn't want to be buying at that high, did you? And now on a new 52-week high made today, is there the chance that we could get a pretty considerable pullback? Yep. Anybody that doesn't believe that from looking at the charts would be a fool. The last time it made a new 52-week high, it had one of its most drastic pullbacks. The time before that, it traded to a new 52-week high. It had a 4-month pullback. There's always the possibility that even though you might want a stock to always go up, that it will continue trading ups and downs and ups and downs and ups and downs. And honestly, this is what you want. This area here, what you really want to see. Believe it or not, you don't want this. Why don't you want that? Why don't we want that in a swing trade? Well, exactly. The harder it goes up, the harder it goes down. Where if we're just consistently making these little runs, and I would not say this is at all a pump and dump gator, just because money runners chased it late. I mean, this is a penny stock that just reported today $3 million in revenue. Penny stock with $3 million positive revenue. Far more than a pump and dump. But when you're looking to accumulate and build your free share positions, it's these areas here that you're most interested in. As a matter of fact, it's these areas here that you're most fearful of. This is why a chart like MCOX likes to have big runs, and big falls. This is why it's hard to go really long term in a chart like MCOX. In all, you'd be kind of dumb to go long term in MCOX. The way MCOX trades, you are better off in all circumstances to just play the momentum of the run. Whether that momentum is 2 or 3 days, or if that momentum is a couple, 3 weeks, hold a position longer term in stocks that make these great big runs. You have to be watching them for when the big fall will happen. What are those Chinese stocks that we saw running pretty good at the beginning of the week? I think, yeah, VISN was one of them. Yeah, this is going to be a good example of the harder they run, the harder they fall. The harder they run, exact pullback on one like VISN would really be about impossible right now. You would expect maybe for it to come down into this area, but that'd be a heck of a pullback, right? Shoot, if you look at the high of the day today, at $18 and your current price of $11.75, you might already say that is a heck of a pullback. You know, ones like this make me feel really bad because somebody bought that at $18 today. Somebody that is ill-advised in their trading bought that at $18. From a high of 440 and a close at 319, already a pretty considerable pullback. Now the point in these is really looking for charts like this for longer term trades. These are your shorter term trades. Charts like this are your longer term, more consistent trades. These are going to be your longer term, more consistent trades to where you can build up free shares. You could simply buy all, sell all, buy all, sell all, buy all, sell all, buy all, sell all. Or you could buy and hold so long as it makes higher lows. You could buy, and on the pullback, cool, I made a higher low. It goes, cool, I made a higher low. It runs, cool, I made a higher low. When it comes to longer term trading, the higher lows is really what will, you know, I did that when I had alerted CACH back in April. I simply wanted to see it make higher lows through the period where I had bought it. I got a little scared over here, but from the first buy alert and the subsequent low after, I allowed it to do its thing. I then marked this as a low. Oh, hey, we got another pullback here as a low. We had gotten a pullback here as a low. And the biggest problem was, since it's been on my watch list, I didn't buy it again. So now I'm waiting on CACH for a pullback. Stocks will pull back. They always do. Don't chase them. Plan for them. When you are looking at an option swing, a good chart to use is one that contains the 8, the 21, and the 34 simple moving averages. We know that when we're trading options that we are not just trading the price of the stock, right? We are also trading against time. And shorter term moving averages will assist you in setting your support and resistance levels to win that battle against time. We look at a stock like Goldman Sachs based on those very things, and we can use a compilation of a couple different trading methods to dictate our trade on it. How would we do that? Well, because options are both a battle of time, or a battle against time, and a battle against price, we've talked about scaling into the options trades and scaling out of them as well. Well, a really simple way to do this, and we'll just look at the current trade that's going on here. On positive movement from your bottom trend line, you've got a good time to be making your initial buy. Now, what this does is it gets you in it in case it makes a jump. Because let's face it, if you're not in it this day and it gaps up that next day, chances are you're not wanting to buy it, correct? Not very many people will willingly chase on a gap up. But in the case where you made your first buy in here, upon the close, towards the end of this next day, where you're like, well, we are definitely closing above the 8 simple moving average, you can sell and buy. This puts you at double the amount, dollar-wise, that you were in from your initial entry. And from your second buy, your average would be much lower. Now, on the following day, you get into that 21 simple moving average. Actually, that's the 34, I'm sorry. And you begin to pull back from it. This would be a time to sell some of your contracts. I generally like to buy thirds and sell in halves. Hard to tell you why. It's just how I like to do it. That's why you always hear me say first scale and buy. I look to do 3 buys in something, but every time you see me alert a sell, it's usually sold half, sold half, sold half. Over the course of the next 2 days in this trade, you kind of went sideways and flat. And today at the open, on a jump, with a wick that has pulled back to the 8 simple moving average, you would have reason to buy A on that tap in positive movement alone, and B, again, on a close above your 34 simple moving average and your 21 simple moving average. Two possible buys today, while already having taken profits on the trade by buying twice, selling half, two possible buys. This would have you fully in the trade at this point in time, and now awaiting one of two things, which would be a pullback under your moving average, which would have you selling some, not all, or taking the full run to your resistance point. Now, Richard, to answer your question on this would go on a basis of a normal planned position size. I typically recommend for people, 10% of your portfolio is a good trade on a stock. So, if you have $10,000 in your account, your options trades might only be $500. Now, in the event that you get the opportunity where I'll buy with $300. One thing I've kind of recommended to a lot of people is do $300 buys. That way you get in with about $900 to $1,000 total. And the good thing about this type of method is options can be extremely volatile. Options can be extremely volatile. And by scaling into them, what it allows you to do is the trades that end up being the big winners, you've scaled in to that ability where you're not just making money on $300, but on the trades that end up being losers, even if they're big losers, those are typically only on your first scale. I mean, if you remember what alerted Goldman Sachs down here, the 165 calls were about $1. Anybody know what the November 16th 165 calls are at now? Now granted, I got out of those. Worried about the whole government thing. And then I said, hey, for the price, we could start looking at the 170 calls. But top bot down here, high top's seeing a 200% return on his buys. When you're buying an option, you want to buy to open and sell to close. Buy to open and sell to close. It's you can get pretty complicated when you start talking about what the sell to open and buy to close are. For basic options trading, let's just talk buy to open, sell to close. There's a reason I don't do a lot of spreads. A former venue I was at, I know that they did they're doing a spread on, I think it's Amazon, might be Netflix. I think it's Amazon. They had bought to open on Amazon. They sold to 310 calls on Amazon. What that can do is it kind of your risk in it because, I don't know the exact prices. Let's say the calls that you did the buy to open on was $200, so 2.00. And when you sold to open, The other contract, be a bull call spread is what it's called. Let's say that was $100. You've limited your risk on your calls already by half because by selling the other side, you've made $100. Now here's the problem. Contracts, each contract is 100 shares, right? If you were to have, if you did that bull call spread, if you bought to open 305 calls and you sold to open 310 calls, right now you'd have to be looking at that and say, well, those are in the money. They could be executed at any time, right? Somebody could actually call on the 310 calls that you sold. And because you sold to open, means you generated the actual contract. That means you're the one liable for producing those shares. Well, if you've got a 305 call on you, you're protected, right? Because you can buy 100 shares at 305. The problem is you have to have that $3,500 in your account. Somebody calls your 310 contract from you, you have to be able to buy the shares so that you can sell them to them at 310. This is something that's not always a call, but you know, in a prior venue I was at, and a lot of you guys know me from there, they do a lot of these spreads like this. And the danger in that is right now today, somebody could call away those shares at 310. And though you may have the 305 call that you bought, you still would have to have $30,500 in your account to be able to cover the shares you would have to buy to turn around and sell at 310. Not really a good trading style for the average person that's paying for a chat service, right? You know, it's very doubtful that many people have just $30,500 sitting there untouched, unused. This is why I don't do the bull call spreads and stuff like that. And I know there's other places that do, but even though you can limit your risk, on the calls, you also have to understand that you can really, really hurt yourself. Because let's also think of this. Chances are you would have been buying 5 or 10 of those contracts, maybe 3 to 5. So now instead of having 30,000 in your account, you needed to have 90,000 in your account just at 3 of those contracts. So I like to keep things very, very basic and simply trade the basic option. Now let's talk about the that we would want to buy. And there are not available on all stocks. Every stock has options available to, you could send the ticker symbol to see if there's options available on it. You could also go to something like stockcharts.com, type in the symbol, it'll say options yes or no. But not everything has options. Now, when we're going to talk about picking our strike price, the first thing we need to look at is what? What's the first thing you all want to look at when you're looking at an options trade? Well, usually it's the price of the option, right? If you're looking at only putting, $300 to $500 in per scale in, you're generally looking at the price of the option and not the strike, right? A lot of people want to say, ooh, I can buy way, way, way out of the money, way out of the money for super, super cheap. And then I can buy more of them. One thing I've found is there's two different ways I do my options trades. One of my options trades is, we'll go over to Yahoo. And this was one I had guided Nina through. Nina had this trade. This was on a ascending triangle breakout for Yahoo. And off of our bottom line here, we looked at playing a lot farther down the road expiration. Back in August, we had her buy a January in the money call. Is not actually trading the option. Does anybody know why we have options? What they were originally intended for? It's really simple. They were designed to allow you to secure shares in a position without, holding back on a lot of capital. Meaning, well, I'd like to buy Yahoo down here, but I don't really know how far it could go. So I might just want to buy the contract instead of the shares, see where it goes first, and if it goes like I really want it to, then I'll execute the contract, and now I have those shares. In Nina's case, we got up here, and that was, at the time, the height of our expectations. Up over 10% on the trade. Go ahead and execute the options. Now you've allowed the trade to develop. It's made you able to get in something that would have held down a lot of money waiting for it to happen. But you've been able to do it by, okay, I don't want to drop $5,000 in Yahoo, but I'll buy 2 contracts down here when they were a buck each. And then when I go ahead and execute it, it's a run, and I'm sitting pretty. That's what options were designed to do. It was designed to allow a $10,000 account to trade like a $100,000 account. American greed evolved options trading into using the volatility of shorter term expirations into the opportunity to make bigger gains. So options trading evolved from what it was intended to, so that greedy people could make more money or lose more money. But in all reality, what they were intended to do is let a smaller account trade like a bigger account. Meaning, you could buy those contracts in Yahoo out a further time. You could buy contracts in Pfizer. You could buy contracts in INTC. And literally by expiration date, or within a month of the expiration, you could look and say, okay, Yahoo performed the best. So I will sell my contracts on Pfizer and INTC, and I will execute Yahoo, so I'm now in that position. Rather than buying all of those positions and holding them the entire time waiting for the thing. It allowed you to secure larger positions and wait for the actual development to happen. And to this day, I still think that's the best way to trade the options. That is by far, trade them. If you look at something like Yahoo, down, you know, if your position size was $2,000, down here, one contract was all you had to buy, and it was $100 at the time. So instead of spending $2,000, you put in $100, and you hold and wait. Your max loss on that contract at that time was how much? Let's be a little more specific. Not so much the dollar amount. What was $100 in relation to the actual position? There you go. Your max loss was 5% on a $2,000 position. Nobody likes to think of it that way. But in thinking of it that way, how dangerous was that trade? It wasn't dangerous at all. 5% as a loss is nothing. Five percent as a loss is nothing. Now, you can scale that number depending on what your normal position size would be. You know, if you're dealing with a $50,000 account and might be doing $5 positions, well, you might have bought 2 or 3 of the contracts there. But even in buying 2 or 3 of them, had you lost every penny you put into the options, you still would have only been losing 5% had you actually put the money in there. And that is the important thing to understand with the option. Didn't represent a $100 contract. Every $100 represented a $2,000 position. So let me ask this now. How many of you have difficulty staying in a position for a long time? I know Do What's going to be like, yeah, that's me. Now let me ask you this. Is it easier to stay in a position for a long time if you've got $100 in it, or if you've got $2,000 in it? Is it easier to just hold and wait for $100 than it is for $2,000? It's going to be much easier. Now, even though this particular method that I'm speaking of now is to have the longer term goal of executing your contracts into common shares, does that mean you have to? Not at all. Not at all. As a matter of fact, let's say you only have a $1,000 account right now today. Let's make that assumption. Your account's $1,000 right now today. You could actually find a series of big board stocks, medium price range, under 50 bucks. You could look to play options out in January, February, March that you could buy for $100 a contract. Even if you're only buying one contract, you would then have 10 different positions. And if somebody, Yahoo, January 2014, $27 calls. What was the last price on those? Would that have been worth a $100 trade? Because remember, with options, when I say 100, it means this, right? It means $1. So when High Top says 850, when he says 850, that really means 850. Not such a shabby idea, huh? Now, when you think of it like that, even though I, in particular, like to use this method to execute to receive the shares of a stock after it makes the run. You know, rather than buying shares in 10 different stocks, I can buy longer term options only to supplement the shares. What does that mean? If my normal position size was 2,000 bucks and I wanted to buy Yahoo at 27, would have been about 74 shares. Okay, well, can't really do an option for 74 shares, so I'd have to suck it up to 100 shares times $2,700 position. I could have bought that call on that day. As a matter of fact, I think it was 101. I think it was 101, so you got to excuse me. But a lot of people don't want to sit and think about what their money could do in a month and a half's time. And what's funny, I bet you that option price was a lot higher up here, wasn't it? I bet you that option was selling over $1,000 right there. I mean, it was up $2 from where it is now. So even though I use this strategy for, well, you know, if you had we could see very easily. I mean, I could go here and we'll do Yahoo, and then I'll you know, you can with E-Trade, you can overlap the charts, and we were talking January, $27 calls. And on this day, man, sometimes it's moved back by a day. But at its high, I think you were on the wrong ones, High Top. Right now at 662, 600% return, 650%. And at its high, 779, 790. Yeah. Either way, the return on those calls, even if you don't even have the account size to think you can even look at a stock price like Yahoo, play calls that are in the money when you buy them and simply wait and playing out longer term. I'm talking playing out 4 to 6 months and being patient. You can trade the big boards as if your account was much bigger. And doing it this way, I mean, I'm going to ask you, who here would not have been willing to buy on August 28th, even to sell up here on 10-4? Or, you know, better yet, really, when it closed below your 8 moving average for the first time. Would you have been willing to hold a position for a month and a week or a month and 2 weeks for the opportunity at a, you know, 500%, 550% gain? Who doesn't want to do that? And even if you're trading on account size that may be as small as $1,000. People want to tell me all the time, well, if I only buy one contract, the fees are going to kill me. It's got to go up $20 before I even break even. Trading the options the way the options tend to be trading, $20 doesn't matter. Why am I willing to hold on my first scale in buys? It's because on my winning trades, I'm 3 to 5 buys into them. So I'm making 100% plus on 3 to 5 scale in buys. And if I lose 100% on the first scale in, I really don't care. I mean, a lot of you guys have already known me for a decent amount of time. You know that I'm pretty good at saying that stock will go up and it going up. I'd say 90% of the time or better. 90% of the time or better, when a stock, when I say it's going to go up, it goes up. I mean, heck, it's probably why a lot of you guys are paying for the service. Because you're paying for somebody that's good at calling them. I have some losing trades. Yes, I do. Everybody does. Anybody that says they never had a losing trade is a liar. The difference with me and them is my winning trades far outweigh the losing trades. Yeah, Richard's joking about them people on iHub. Yeah, and Gator's right. Especially if I say I like it, but I'm not buying it, that's when you should buy it because it runs like crazy. Now, this particular method, got one in here that likes to get me thrown off with the private messages. This particular method is going to be a great method not only for those of you that are looking to enter a stock as a long-term investment, but also for those of you that are trading on a smaller account and want to see bigger returns on that account. Now, let me ask you all this, and be honest. Because if we can't be honest about it, we probably can't correct it. Would you say that not necessarily half your trades, but half the charts you look at that you say, I bet this goes up, would you say at least half of them actually go up? And if the answer is no, we definitely got to do some work. But if you can look at a chart and say, I think this chart will go up, and a week later, 2 months later, it is up from the price you thought it would go up from, and you can do that on half of the charts, you can be a successful options trader. Why? Well, we're talking about these longer term contracts, like back in all buying January calls and somebody with a smaller amount just holding them. John, I'm not even talking about a stop. Think of this. If I would have bought one contract on 10 different that were at $1 each or $100 coming out of my account in this same type of situation, knowing that that $1 at one point had turned into $790. Sorry, that $100 turned into $790. Do I have to be that good? Can I afford a couple 100% losses? If the average 300 to 500%. And what I found in trading options like this, when you're trading out further, even though I use that to turn around and just buy the shares, execute the contract and buy the shares, what I found is that on the ones I'm doing that on, I'm consistently seeing those options up 300 to 500% when I'm executing to buy the shares. Why do I execute and buy the shares? Well, I can turn around right away. I make money on selling covered calls immediately. Because when I'm executing to buy the shares, it's not as it looks strong and going up. It's as it looks like it will pull back. So I execute to buy the shares so I can write covered calls in anticipation that those calls will expire worthless. Pretty simple thing. So with this being said, those of you that are trading with smaller accounts and or those of you that are interested in more longer term investments, but you to have that, identify points and charts that are not just good to buy, but hey, I'd like to buy Yahoo, but I really don't want to sink, $10,000 in it. Buy the contract 4 to 6 months out, hold the contract until the chart looks like it'll be pulling back, execute the contract to free shares, sell the covered calls, and you know what? It's also not a bad idea to buy a couple extra contracts too. Because that way you can make the money on the contract as well, right? Now we're going to look at another one. Using that same type of strategy. Remember, that strategy was using in-the-money calls that were further out. Now, if you guys remember, over here, we alerted a long-term buy off the 200 moving average on Pfizer. At that point in time, $27 or $28 calls would have been decent. So let's look at January. $28 calls at that point in time. You could have bought that call for anywhere between $1.14 and $1.39. That's $114 and $139. And even though it's had a bit of a rocky time, is it up or down right now from the buy? There's the current price. And this one's been quite the slow mover. So using that same strategy, in 4 to 6 months out on a longer term investment alert, here you've got one where, okay, you're not up 100%, but you're not losing. And even though if you were in the stock, you might have had times where it was kind of scary and you might have wanted to get out, you really got nothing. You're playing far enough out, you can simply hold. Now, let's say that you had bought both of those contracts, Yahoo and Pfizer, played in the January calls from the alert. So just to get that straight, and so we have it, the Yahoo calls were actually at 101, and we'll even use the high on Pfizer from the day it was alerted. It didn't say one. And on INTC, right about that same time from when Pfizer was bought, was an alert made on INTC when it was a watch list. But, you know, we'll even talk about more recently down here. And we'll look at a $22 call. We'll see what the price was on the $22 call. And we'll say $1.45. That was the high on the day when I alerted my entry in a long-term position. I actually bought the shares down here. And you could have bought a single contract, we're going to say $1.45. Now, if you were still holding all three of those contracts, if you were still holding all three of those contracts, and I'm talking only buying one of them, for those of you that may have smaller accounts, you'd be sitting right now today okay? What that really means to you is that had you put in $101, $139, and $145, you would have put $385 into the trades. Now you want to say, well, what about my fees? Okay, let's do plus 10, plus 10, plus 10, and we'll even do E-Trade 75 cents a contract, basic, unless you negotiate it lower. So there's what you have in it until you sell it, and then there'll be different fees. So $417.25 is what you've spent to make these positions active. And what you have right now is 690 plus 203 plus 189. Now, if you were to sell all three of these today, you'd 10, 10, 10 minus 75, 75, and we will go ahead and subtract what we had in it. And your total profit is $632.50. If you have a smaller account, or if you're scared about the volatility of options, trading this particular method is a good way for you to play a stock longer term, not be succumbing to the volatility of the option, but always making a higher percentage in the stock. Gator, your question. Yeah, I mean, you look at my position in Intech when we talk about just free shares in general. You know, unlike an option, common shares, I'm not battling time, right? If I'm just playing shares, there is no battle against time. There are people out there that they want to buy and just set the money out there, and hopefully years from now their money is worth more money. The whole point of the free share conversions is there's always a risk in trading, right? Is there ever a trade you can make with zero risk? Well, I mean, the answer is no, because a trade means a buy and a sell, right? And any buy is going to have a risk. The risk is that the price will fall below where you bought. But, you know, let's even use a recent pump and dump, SCRC. I've got a very good friend of mine that bought this in the 33, 34-cent range. Over in here, and actually even before that, I was screaming, hey, why don't you at least sell some or sell to free shares? That person's answer was, well, what if it keeps going up? Well, that's what the free shares are for. You're still in the position if it goes up. Or at least sell half in case it goes up. When it hit $1, actually when it hit like 90 cents, I told him, I said, listen, man, on these pump and dumps, if they can get to $1, that's like a magnet. I said, you need to be on, sell to free shares at $1. Do you think he listened? I'm going to show you where he sold at. You want to talk about an eerie feeling. And I'm not going to say the person's name because they're a member of our chat room here, but it's a good friend of Nina's as well. But you want to talk about a disgusting feeling. Buy something at 33 cents, watch it go over $1, and then sell it for a loss. All because the same things all traders have a problem with. We always think it's going to go higher, right? We always think it's going to go higher. We always think that we need to try to get the absolute highest sell. When I told him to convert to shares at $1, you know what he told me? On iHub, they're saying it can get to $1.50. I'll sell there. The sad thing is, you know, actually, let's stay here with SCRC. Had that person even just removed their capital from it at $1, let's look at this. If they would have removed their capital at $1, they would have been holding 2/3 of their position bought at 33 cents, right? If they bought a position here at 33 cents, they sold it to free shares at $1, they would have all their capital back and still 2/3 of their position. Do you guys agree with my math on that? So now you have this big dump day, right? Dump day. And you're like, dang, this thing could be over. But then you get a day where you're in the green. Can you buy without risk? Or better yet, what is your risk in buying? If you're on free shares, you can control your average price, right? If I wanted to buy this again at, let's say, 50 cents, when I'm like, dang, this thing could bounce again, could I not control it to where my average was $0.25? How could I do that? If I wanted to buy at 50 cents, how could I control it so that my average was only $0.25? Buy the exact same amount of shares I'm already holding. If I was holding 5,000 shares and at 50 cents I wanted to buy, I could have an average at $0.25, and now 2 days later, well, crap, this thing's looking like it could pull back. Why would I think it's going to pull back? Well, it did the entire move before without a red candle, right? The entire move before without a red candle. Now it's got a red candle. I can go ahead and sell to free shares, or I can just sell the position that I bought. When it comes down here, could I buy with less risk? And yes, I could. I could buy with a lot less risk because I could control my average if I still had free shares, right? I have control over my average. Well, ooh, cool. We're 3-4 days into the green and we get a red candle. I could again just convert to free shares, or I could just sell what I bought there, still having my free shares from before, just to allow me to continue to play the chart. The cool thing with that being, we get to a day like this. Day, right? Looks like a good money on your trade, right? All you do in that case is sell the shares you bought here and enough of your free shares to still get your capital back. Sometimes in that case, your free shares will dwindle. You will lose some of your free shares in the process of the trade. Excuse me for just one Sorry about that. Anyway, you could use this method if you actually believed in a stock and you thought maybe it was just taking a hard. You could use your free shares to leverage yourself and be able to continue to trade the chart. But to simply hold, to simply sink money in it and walk away, to me is just downright stupid. You know, Genentech, oh, my chart just froze up. Give me a second. I'll make sure you're going through the other lessons that I've got posted on the website. They're all pretty valuable in their own way. Okay, here. Yeah, we'll look at one like Intech here. And, you know, I've been kind of getting frustrated with the idiots on the iHub board because I do post there a lot, and they're just a bunch of idiots there. You see, some of those same people were telling people that, you know, this right here was the time to buy. Now, one thing I've always done when I post on one of the boards on iHub is I don't just say, ooh, this thing could go up, just hold it and you'll always make money. One thing I like to do is tell the truth. You know, when you're looking for new investors in a stock, what's going to make somebody more interested in the longevity of the stock? Being able to buy and make money right away, or buying and having to hold forever until they have the chance to make money. People are going to be more interested when they see their stock go up. You know, it's funny. Over here, when we did our free share conversion, we did our free share conversion over here on Intech, and the iHubbers said I was a liar, and then they all asked me, well, where are you going to buy again? And I said the low 09s. And people said there's no way it's going to get to the low 09s. You look at this chart, it's not going to fall. What did it do? And Richard can actually attest to this. I met Richard on the Intech iHub board. And Richard, I actually think when we met was after this sell alert, right? Was when I got on iHub and said, hey, we sold today. And we're expecting to get it in the 08s. That's when I met Richard. Because everybody said there's no way this is falling down to the 08s. And when it did, all the people that told me I was full of crap were to say. Here, and I put it on the iHub board, and I said I'm looking to buy back in the low 09s. Those same people told me I was an idiot and it wouldn't fall there, and then they shut up. So the other day, when I put there that we sold and that I would be looking to get it again, in the mid 09s to 10-cent range. And then yesterday on momentum, we bought at 13 cents. Of course, those people said, well, now you're just a liar because you said you weren't going to buy until it fell again. They don't understand that money runners created momentum, and being on free shares, I had a risk-free buy. Well, not risk-free, but very limited risk. I controlled my risk. And you know what? When I told them that we sold today, do you think they said I was smart or that I was an idiot and a liar? And now I'm banned from, I actually got banned from iHub today. Because I had like 30 people call me an idiot and a liar, and they wanted me to show proof of the alert. So I tried to share a screenshot. Well, iHub won't let me post screenshots because I used to post charts, and I thought I was slick. Because my charts would say like this right on it. So they won't let me post screenshots anymore because they said I was advertising with them. So then I actually tried to put some of the screenshots on my website and give them the link to it, and they deleted those messages because they said I was advertising my website. So it's like all these people are like, you can't prove it, you can't prove it. It's like, I really don't have to. But getting back on topic, Gator, when you said like your aunt that just likes to dump money in it and walk away. If you dump money and walk away, you're always taking the risk of having it fall. Now, somebody might say, LUV, depending on where somebody bought it, that downfall didn't hurt you any. But one thing I'll say, and I'll always stick to, is if I can acquire right now I have 1,080 free shares of Amazon. And if I can use my free share accumulation method on a $300 stock, I think we could use it on anything. Yes, Fevin, I believe we have to take what the chart gives us. We have to take what the chart gives us. Yesterday we saw minimum, so we bought, and it gave us a 15% trade. But we've traded this, not just our last 4 trade alerts for free shares. This has all happened just since we started our chat room here. All of these buys in these areas. Actually, let me do this a little better. Those were my buy alerts. For our free shares, those were the sell alerts. I think I've done a pretty decent job of calling this chart accurately. Is what new? Yeah, we launched our chat room on August 22nd. But I've been doing my newsletter for about 11 months without a chat room. But, you know, what I was getting at before, like with Intech, those people, when I said that's not the time to be telling people to buy it, now they look back and say, well, you were an idiot because the price went up from there. Well, the price only went up if you held for greater than a loss. But once we confirmed that the lower lows were over, and I alerted it there, and sold it there, and I alerted it there, sold it there, then that was the shareholder meeting. And those of you guys that remember from the other venue I was at, I was actually a little bit scared going into the shareholder meeting. Why? Because their CEO would not confirm to me whether or not they'd be doing a reverse split. But after the shareholder meeting, we bought it, sold it here, bought it there, and sold it at the high. And actually, we didn't even buy it again until down here. But those are all alerts that most of you guys have seen me make. I think I got a pretty good handle on this chart. Rucker, that's one thing I have been sharing with it. Our last buy in the 09s, these low 09s, that sell alert there was a convert to free share alert. I alerted the sell at 1481. We had bids at 1481, and that's where we sold. I sold at 148. Now, getting back to what Gator was asking, like charts like LUV, do you know when your aunt got in LUV, Gator? You don't even have to say the price, just about what month? Oh. Well, here's the thing with free shares. still hasn't made it back. Where even if she wanted to just park money in it and let it be, is as soon as you start to see lower lows, even, as soon as you start to see lower lows, sell it down to free shares if you're up on the position. Now let's think of that. If she sold to free shares, let's even say she sold to free shares here on this lower low. And she gets in, okay, now it's made a higher high. And she buys again. Well, it was pretty clear during this time you should have been selling. So we'll say we're a little slow. We didn't get the point right away. It took 3 weeks, 4 weeks to realize we should have sold. And at where we make higher lows again, we buy. And then, you know what? We're definitely looking to make a lower low right there. So we sell to free shares. And then over here, we make a higher high, or higher low, I mean. So we buy. And we haven't made a lower low yet. So using free shares even in a longer stretch of thing, based on higher highs, higher lows, lower highs. Well, Gator, like I said, I've used this method to acquire 1,080 free shares in Amazon over 5 years. Well, I mean, it wouldn't matter if she only bought with $1,000 on this. If she saw 17, 18 bucks and held through all of this, there's no way that those people could tell me that converting to free shares, even on the longer term, based on a weekly with higher highs and higher lows, wouldn't have been more profitable. Even using just $1,000 to do the trade. Well, Tuan, those type of questions, it's all relative to your account size. That's all relative to the size of your planned positions. But Amazon's a rather easy one. You do not, Richard. You can simply sell the contract. But Amazon, here's the channel I'm following. But, you know, with Amazon, if you follow this channel and buy off either one of these two bottom lines and sell into either of these two top lines, you'll make money. Well, John, when you're talking about one like LUV, you don't short-term trade LUV. You don't trade action for what it does tomorrow from where it was today. You simply can't trade that way, or you end up stopping out just to see it run on you. You know, quite simply, you never sell in consolidation. Never sell in consolidation. And if you're buying for the first time, never buy in consolidation. Consolidation, where do you buy or where do you sell? If you bought LUV down here and it comes up and it's consolidating in a range between your swing points, where do you buy and where do you sell? If you bought it down here, when would you sell it? If you bought it here and it runs up and it consolidates, where are you looking to sell? If it closes below that line, not the wick below, if it closes below that line, you sell it. If you buy here, you don't sell unless it closes below your consolidation range. Your consolidation range will be made by the prior swing high and the top of your consolidation. Prior swing high, current swing high. If you weren't in it, and you were looking to buy, where would you buy? Well, the best going to be on the break above the consolidation. The other answer is a little bit more dangerous, and it'd be on that lower line. But if you're playing a trade you believe that can continue to go and it's consolidating, you buy it on a close above the consolidation. Otherwise, you just wait for a significant pullback. Now, Tim, you're saying you were having trouble seeing the higher highs and higher lows. This low right here was $12.58. Oops. This low here was $12.58. This low here was $12.65. Is that a higher low or a lower low? No, it's a higher low. 1258 and 1265. 1265 is 1258. So it is a higher low. And what we like to see is the higher low that comes after a higher high. This drop here, that run up to here, we made a higher high from it and then made a higher low. In all reality, anybody interested in LUV should have bought it when it closed that day. So what I want to do is kind of get back on topic. I kind of strayed from it completely. We were talking about swing trading strategies. We talked about it, specifically like with options. Yes, Rucker, I have types of studies that completely guided my trading strategies. 8, 21, and 34. So we talked already about a specific strategy that you can use if you're wanting to secure a position for the longer term, or if you just have a smaller account, the heavy volume, but you want to be able to make more than you could make on the stock. We used a few of our recent alerts on long positions like Yahoo, Pfizer, and ITC. And guys, I know a lot of you are sending me private messages and stuff, but when I'm recording this, then I can't even answer them. Just so you guys know, I can't even look at them. But anyway, strategy we talked about, if you have a smaller account or you maybe have a fear of the option strategy or the options volatility, I mean. Now we're going to talk about the other strategy. Now this strategy is a slightly riskier strategy. And if the risk is higher, what would the reward be? There we go. A lot of my shorter term swing trade alerts that you guys see me making in options we're getting to that, Gator. Talking about swing trading options, but not necessarily trading in the money calls that are 4 to 6 months out. You know, in reality, most of you people don't want to trade something that far out. Like I was saying in the example I made on that Yahoo, the INTC, and the Pfizer, was really based around if you wanted to secure the long-term positions, or if you had a smaller account, how you could see growth on that account in what I would consider to still be a relatively short term. A month and a half to double your account is good. At least in my book. I think it's pretty good. If you can double your account in a year, I think it's pretty good. And I don't care if you've got $1,000 or $1 million. There's nowhere else out there that you can't double your bank account in a year, that's for darn sure. But we're going to talk of 2 ways to kind of help pick your options here. Now, the first thing would be what on an option swing? And these are our shorter term swings. These are the ones that go anywhere from 2-3 days to 3-4 weeks. What's the first thing we got to look at? Nope. We're trading 2 things in options, right? Price and what? Time. So it doesn't matter even the price of the options. It's, do we want to buy something that's a week if it could take a month to maximize the run? You know what Gator was talking about with the golden nugget of how to pick stuff? Just a simple thing. Right now we're trading this channel on Goldman Sachs. I've already told you several times that I look to get out of an option swing no matter what 2 weeks before they expire, right? So right away we know that 2 weeks before they expire, I'm done with them. And literally, we can count days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days till it first touched that top trend line. From here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days. So if I am looking to get rid of an option swing, and both of these runs were 14 days long, how far out do I need to play my option? If I'll sell my contracts 2 weeks before they expire, no matter what, there you go, 1 month. Because I'm expecting 2 weeks to go up, and actually that's 3 weeks if you think about it. 14 days is 3 trading weeks, plus 2 weeks on top of it. Entering from down here, which was a week ago, we needed the November 16th calls just to maximize the potential in the trade, didn't we? So that's our first trick. Everybody wants to talk about wanting to get the highest price on their sells. I'm content knowing I'll rarely do that. Except for I was pretty proud of myself with the Disney calls. I actually did sell I was the absolute highest sell on those. That I don't even care. But what's the next thing we need to pick? Now we've picked our expiration date. What's the next thing we need to pick? The strike price. Now, when I first entered this on the 165 calls, and we were getting them for $1 or $100 each, how did I pick the 165 calls? Well, my target was always this top line. And all I cared about, because I'm not looking to execute these into actual shares, or all I care about is picking a strike that was that would go in the money should the target be met. So today, when I brought them up, it was, hey, I had already sold the 165. The 170 calls were about $1, and they should be in the money should we hit our target. Now, I'm going to ask somebody to do me a favor. Just look up and see what the November 16th $160 calls are at right now. Now, we'll play some give or take on the theta money. Considering that would only be $1 in the money, $1.50, and right now these are $2.25 in the money. We'd probably be looking at between $3.80 and $4.25 for the sell price up here. Not too shabby, right? When I'm doing just an option swing trade, meaning no desire to convert to shares, no desire for anything to one run, all I care is getting something cheaply priced in this range that, should the target be hit, would go in the money. That's all I care about. So on these shorter term option swings, how do you pick your expiration date? Yeah, like if you're trading a channel, the average length of runs within that channel already. And how do you pick your strike? Well, Gator, it's not even the closest reachable. I mean, when I bought the 165 calls down here at $1, the 170 calls were at like 55 cents. They were just as obtainable as the 165s in the essence of, should it continue to trade in the channel, they would go in the money. Now, here's the other thing. You could say, well, what if it doesn't go to that top line? Is that possible that it won't come up and hit this top line? Yep, it's possible. And that's going to be when they go in the money. When you're trading options, just kind of reviewing a couple of the things we've talked about. When you're trading options, what are the safest options to buy? In the money. What options to buy? Not just out of money. Not even just far out of the money. How about out of the money that is not attainable in the trade plan? Obtainable according to this trade plan. So a 175 call right here would be risky. Why would it be risky? No, Richard, in the money would be like if you were buying the 160 strike right now on Goldman Sachs. It's in the money. But you guys are right. Why is it so much risky? Because as this thing goes up and begins to pull back from that top channel line, and you are still out of the money, good luck getting out of them. I mean, literally, over that time, even though time decay isn't against you in any option, once you're in the money and close to the money, them last couple days aren't really going to matter for time decay. But when you see that 171 or so and then a pullback, see those 175 calls take like a 50% hit that first day on the pullback. You know, one thing I cannot stress enough when I talk about options trading, don't always because it's cheaper. Don't do it. Just because it's cheaper. Be prepared to lose. You know, like I like to watch Amazon and Netflix, even for my scalps on options. I like to play one strike out of the money. I might be paying between $300 and $500 for the contract. But I'll tell you what, if I was buying the $100 contract that's 2, 3, 4 strikes out of the money, very, very subtle changes that I might lose 10% on my contract, I lose 40% on the cheap one. Now, here's the other cool thing about option swings. And you can make money doing even though I choose not to. You could follow a chart, Goldman Sachs, and what could you do with it? I wouldn't always play in the money is because I'm not always intending to convert them to shares. And also on one like that, playing in the money at the time you were going to spend $1,000 per contract. But there's two types of options contracts out there, aren't there? Anybody know what those two types are? We've been talking about calls. Puts, right? Do stocks only go up? Nope. If they only went up, it'd be easy. We could put all of our money in any stock out there and we'd never lose. Now, channel here, Goldman Sachs, don't we? Now, assuming that Goldman Sachs goes up, hits our trend line, and pulls back from it, we wouldn't have been wanting to buy on the green day, but on the red day that was clearly pulling back from it, and on the red day that was clearly pulling back from it, could we have made money on the puts? Now the cool thing is this means you could get twice as many trades out of the same chart, right? You could get twice as many trades out of the same chart. One thing I found in puts plays as a swing though, the puts plays rarely play out as good as the call plays. Meaning small subtle bounces like this, even though it's still in a downtrend, we'll see very, very large decreases in a puts price. Which is why I've chosen to, I don't swing puts plays. Because if you think you're touchy on a calls play with when to buy and when to sell, you'll be really touchy on a puts play. And then in the end, you'll just be angry with yourself because you will have sold too soon. Yep. But what else can we use puts for? What are puts? There you go, Moss. Insurance for your stocks. How's it insurance for your stock? Well, what a puts contract is just like a call is the right to buy at a put is the right at the strike price. So somebody up here long in the position, they're holding Goldman Sachs shares. They trade. Okay, it's looking to pull back. I'll buy 170 puts. And then they come back, oh, cool. Well, it's still trading within my channel. So on the bounce, they sell their puts. They'll buy an in-the-money put. And their hedge, their leverage, their insurance for their stock is if it fails this channel line, they have the right to sell at the strike price of their put. Not a bad idea, is it? Could we use that in some of the smaller price stocks we trade? Yeah. I actually was looking at this today and wishing I would not have sold the free shares in AMD yesterday. Because as I thought about it, the $4 puts are pretty darn cheap on AMD. And the fact that I had common shares, in the real danger, when's the dangerous area for AMD? When do I really need to be worried for AMD? Tomorrow. Earnings tomorrow. So high top, do me a favor. What are the 1019 $4 puts going for? Was last earnings. Gap down from earnings day. For every 100 shares I was holding of AMD, rather than just selling them, I could have spent 20 bucks for every 100 shares I was holding, and I would have a 20-cent cushion from current price. So from 409 at 489 or 389, that would mean if they're not off buying those puts and selling my shares based on the puts contract on Friday, if this was under $4. I could have played that out a little longer term too, maybe into November or something. But AMD has puts, has calls. Siri, calls and puts. RAD. Uh-oh, my charts freeze up again? Yep. Give me 1 second. But, you know, RAD has calls and puts. Matter of fact, a lot of your stocks trading at $3 or greater are going to have options available. So rather than always worrying about when to buy, when to sell, when to buy, when to sell, we could actually buy, sell. We could do what? We could buy the puts, right? If we're worried about, we could simply buy the puts. You know, if you're holding a common share position, we'll go back over here to AMD. If you're holding that common share position in AMD, are you really worried about 20 bucks on every 100 shares? Or are you worried more about the money you have in the position? If you're trading something like AMD, that the $4 puts expiring this week are 20 bucks, are you more concerned about that 20 bucks per 100 shares or the money you have in the position? So would you care if you bought cents each and it kept going up and those puts were really worthless? You know, Moss uses the analogy that puts can be used as insurance for your stocks. Do you guys? Are you filing claims on your car insurance regularly? Well, there you go. They're only 12 cents. So 12 bucks on every 100 shares that you own. But people pay for their car insurance. I haven't filed a claim on my car insurance in years, but I still pay it. And honestly, I'm not even going to say I pay it because I have to. I pay it because if you ever did need it, it's going to cost you a lot more than had you not been paying car insurance. So another way to use options, in your trading is if you're wondering when you should sell because of the risk involved with it, you could simply buy the puts. What do the puts do? Calls give you a right to buy at the strike price. What do puts do? give you the right to sell at the strike price. Easy deal there. It's a pretty easy deal to say, if I think my stock might fall, but I really like this stock, I can buy the puts in case it falls so far that I don't like it anymore, right? If it falls so far that I don't like it anymore, I can buy the puts. It doesn't mean I have to sell my shares the second it drops below $4. It just means that my right to sell at $4 ends when? Well, in that case, it'd be Friday, expiration day. You guys ever buy a stock at this price range? And you're buying and selling and buying and selling back at it, you're like, it only pulled back a little bit. You guys ever do that? I do it. Why not look at buying the puts, and if it pulls back, it pulls back. That's what they're there for. They're not just there so scalpers can make money on it falling today. That's not why the puts are there. And that's one thing that I hadn't really done before personally, and I've been studying a lot on. And that's what I said yesterday when I sold the free shares on AMD. I really got to look at it, and I said, you know what? I should have never alerted selling to free shares. We could have bought the puts fairly cheap, and it would have protected our common shares should it fell. Now, when you're buying puts like that, what are you really hoping for? You're in a common share position, you're buying, what are you hoping for? I'll go with Scott's answer. You're hoping your puts are worthless soon. And in a perfect world, maybe you're hoping that you get a pullback to an area where you're like, well, I really don't need to stop out of this, and it's clearly going to bounce. Like, had you bought puts here and it dipped here, but man, that's right above I don't need those puts anymore. I'll sell them. So I made money on the puts, but I didn't exit my position because I felt comfortable that it was going to bounce here. But really, in the perfect world, you're hoping to never even care about the puts. Just like you're hoping to never really need your car insurance. Because if you need your car insurance, something bad happened, right? If you need to use your car insurance, you had a bad day. So just some things to kind of think of that actually you're going to see me integrating more and more in our trade alerts. Because, hey, we could have leveraged our common share position with puts. We didn't need to sell it. So, quick bit of review here. We talked about two different types of swing trading with options. The first of which was a way you can use options to later turn them into common share positions in a way where you're not tying up your funds until it does what you want. And this was playing longer term options, 4 to 6 months out, so you had plenty of time to let a move evolve. We used the example of how we did that with Yahoo. On that ascending triangle breakout, buying down here, knowing that, hey, we could have hit resistance pretty easy and pulled back from it. We also knew that we could have hit resistance up in here and pulled back from it. But as it broke above those resistance points, to execute those into shares that we can then let the shares evolve and continue for us. But we could also use this type of strategy if, A, we have a smaller account size and we want to trade big board stocks that generally follow the rules a little better than small cap stocks. Or maybe we just don't trust options trading and the volatility that much, and we want to make some nice gains, but we don't want to lose 50% in 5 minutes. And all we've seen is, man, I was talking to a guy and his option went down 50%. Well, that's usually weeklies. That's not going to be something that you're buying 4 to 6 months out. We use those examples of Yahoo, Pfizer, and INTC. And like I said, with this method, if half the stocks you look to buy into go up, you'll make money. The average options gain type of method is between 300 and 500%. Granted, it could take a couple months to get that. They will be slower trades, I promise you. But if you can pick the direction on even 50% of them, it won't matter if the 50% that lose 100%. Because if your average gain on the winners would be 300 to 500%, if you lost it all on the others. And what's ironic with that too, very rarely would you lose it all. I'll get to doing other when I'm done with my lesson. The other method we talked about was a little more dangerous method It was a higher risk, higher reward method of swing trading options, but it was still in a controlled manner. We talked about Goldman Sachs. And how we could trade within its trade channel. It's given us a very clear trade channel. And we could trade within its trade channel by picking a strike that would go in the money within the trade channel. So rather than buying an in the money call that was already, $700 to $1,000 a piece, we could buy one that would go in the money and make our profits off of that, regardless of how many you may buy. I have people that ask me all the time via private message, sometimes just in chat. I get emails about it. Say, you told me to buy with $300 and those contracts are $150. Is it really worth it for me to buy 2 of them? Is it really worth it for me to buy 2 with the fees I got to pay? Yes. It's an option swing trade. Let me ask High Top, 2 people that have followed in several different venues. Are we looking for 100% trades, High Top? With our option swing trades, are we looking for 100% trades? No, we're looking for better than that, aren't we? And do we regularly get better than that? So does it matter if I only told you to buy 1 or 2 contracts? Does it matter if you... The other thing I want to say with High Top, how many of my alerts are you still only buying 1 to 3 contracts on? Since you joined my service almost 3 months ago, is your account up or down? Have I failed you in anything I talked to you about before you joined my service? So I didn't fail you. It was only when you didn't listen. And now here's the most important thing. Have I ever given you a losing trade alert? Yep, I've made losing trade alerts. But you're regularly buying 2 to 3 contracts like I've told you to do. You're regularly getting over 100% gains. Your account's up since you joined, and we still have some losing trades. I'd say the trading system works. And I know you're a believer in it, aren't you, High Top? So when we buy a contract, just talking basic options trading, when we buy a contract, How do we buy it? Do we buy to close or do we buy to open? And when we sell to close. So buy to open, sell to close. Those two things, even though they're simple, they're huge for those of you that haven't traded options or are new to it. Buy to open, sell to close. If you sell to open, that means you are generating the contract, which means if you sell to open puts, you are saying, I will buy your shares at this price. And if it completely tanks and falls apart, guess what? You have to buy the shares. If you sell to open, calls. And those calls end up in the money and somebody executes on those contracts. You got to have the shares to sell them, don't you? I don't do them at market. Sometimes I just buy them on the app. And I sell on the bid, just like Nina said. But so many things can happen when you do market orders that, I mean, you see it in Pennyland all the time, but you could get screwed. To say the least, you could get screwed. Final thing we're going to talk about with swing trading in general is going to be, the other things we've alluded to. Free share conversion. And I know this is a long lesson tonight, and I'm surprised that I do it with such enthusiasm being there. But this is really important stuff because it explains to you how I trade. And it's important for you to know how I. Oh, my chart froze up again. Why is it important for you to know how I trade? Or to understand how I trade? Trust, that's a good answer. Even more than that, let's be real simple. We're going to be even more. You guys are too heavy. To have an understanding of how I trade and why I trade the way I trade, why is that important to you? Jerry, there you go. I mean, the simple reason is you guys are paying me for my trades, aren't you? And I don't mean to sound cocky about that. I'm not at all. Those of you guys that know me will know that I'm the most un-narcissistic person in the world, regardless of what they say about me on iHub. See, Richard laughs about this because he reads the boards where they call me the narcissistic person and tell me I'm all full of myself. You guys know, those of you guys that know me know that I'm probably the most humble person in this type of environment that you'll ever meet. You know, and I've been in different chat rooms myself, and I've never had anybody care about my money. But I've never had anybody prove it to me. And that's one thing I try to do with you guys every day. I mean, to the point where my alerts aren't even tailored to show the way I would trade it. It's in a way where you can trade it. But time and time again, I set out to care about your money. And let me tell you this, it's not just because I want you to keep renewing your subscription. So, talking about free share conversions. I alluded to this earlier. What's the first thing I look for before I want to go long in a position? What is a stock? You know what's funny, Fevin? Just kind of talking about that. Those people don't realize that the more they bash me, the more people contact me about joining here. Moss, the question was, before I go long in a position, what do I look for? What does a stock have to do before I go long? Yeah, I like to see an overall uptrend, but what's the most key thing? Why do I have the RVLT chart up here? There's a reason I chose this chart instead of Intech. It has to be your hand. So once a chart creates a higher low, I look to go long in it. That sounds pretty simple, right? On a daily chart, well, Tuan, that's LT here. You know, those of you guys that were Lancaster sent me a PM earlier telling me to remind you guys, never buy a restaurant because he's stuck at work right now and couldn't join us. But Lancaster and Adam the Contrarian, they can vouch for these alerts. I started alerting RVLT there. And we did free share conversions on all of our buys and sells. Where was it? Sorry, I'm looking at another screen to see where my actual sells were on it. was actually where I said, let's just sell our free shares. Then here in our chat room, you guys saw me alert it here, and it went up and I held it. We sold the free shares there. We bought here. I didn't sell to free shares there. I sold half my position. And we bought it. And we sold it. We actually got about 6 cents from the high of the day a couple days ago. And you know what? I said, hey, it's a little bit risky, but I kind of like it here. And granted, it dropped about 10 cents, but like I said, if you're on free shares, you control your average. See, in reality, RVLT, once it made this higher low, it put us in really good shape. To begin, how do you accumulate free shares? That's the big question people have asked me. How do you accumulate free shares? You know, Rucker had asked earlier, how do we do when should we do free shares on one like Intech that I've been accumulating since 0006? No, Twan, this was one I just kind of, I put out to people to say, hey, if you're on the free shares with it, if you're already on free shares, you kind of had a low risk buy because you could control your average and you'd want to keep it below the 50 MA. So this was kind of just in chat. Because again, Twan, the reason why is, let me ask you personally, do you already have free shares on RVLT, Twan? I didn't want you to come in and see the announcement on one like this and buy it, as opposed to which, even though we bought on free shares, pretty much hit support today and bounced. Was a little safer. You see what I mean? RVLT kind of has a 3-day consolidated bottom, could take off from it, but really not at any type of support level. AK Steel, kind of right there near support. RVLT, okay, for those in free shares. AK Steel, off that 20 moving average, probably a good entry for anybody. So I do that because I don't want people coming in, looking in the announcements and going, ooh, Coach bought RVLT. I should buy it too. Because if they're not on free shares, and that's what I was alerting that off of, that's why. So how do you convert to free shares? That was the question. The answer is simple. Anybody know the answer? There you go. You don't look to take your profit is the shares you sold. So if you put in $1,000, you're looking to only sell enough to get your $1,000 back. And fees. You want to get your fees back too. You want to make it literally completely free shares. So if you bought $1,000 worth down you would want to get 1,020 back when you sold, right? Or whatever your fees are. When I talk about fees, I generally use that $10 average. So the conversion to free shares is a very, very simple conversion. If you're in a stock that you want to accumulate free shares on, and let's leave fees aside in this, example. But let's say stock runs 20%. And the stock is making higher lows, and you believe it'll continue to do that. So it runs 20% from your buy. How much of your position do you sell? %. How much of your position do you? 50%. It's not hard, is it? And when using the free share method for your swing trading, here's what and we're going to get to some of that when I get into some charts after I'm done. Jerry, and also Fevin, we'll be actually talking about a couple with Intech, EWSI, some other ones some people have asked me to look at. But what's the importance of free shares? Is it so that more of a profit and now you can't get as much profit? Is that the importance of free shares? Oh, I would say on that, Moss, that free shares, when you convert to free shares, generally has you selling a large portion of your position. So on the big pop, you'd probably end up buying back in but having a lower average. So that gets me to the true free shares. And that would be limited risk on future buys, right? When I'm on free shares, I can completely control my average. Let's say on RVLT that I only have 100 free shares. And today when Coach was talking about buying, he said keep your average under the 50 moving average. Man, for me to do that, I can only buy, what, 3? Oh, well. When you have free shares, if you're only on free shares, what is your average price for the shares you're holding? When you've already gotten your original capital out of it, the average price for what you're holding is 0. Which means if I had 100 free shares here, and I bought only 100 shares, my average is 50% of the price. I drop 50% before I take a loss, right? I can literally, if all I did was double my position from what I had on free shares, I could take a 50% loss and not lose money. What's the likelihood of a stock dropping 50% and you not being able to get out? So with free shares isn't always building you this big, huge nest egg that you hold on to forever. Really, it's about limiting your risk on future buys. That's what it's all about. If my risk is low because I've got a lower average, I can literally buy at any price I want. I don't have to have a reason to buy RVLT here. I don't have to say, well, it's at support. I could literally say, I think it, and just like I thought it could move over here, even though it wasn't near support here. If I think it could move from here, I can buy without a reason. A reason meaning a validated chart reason such as support. You know, a lot of people kind of misconstrue the free shares as the let me build this big, huge nest egg. Believe me, I never really was an Intech. But if it keeps letting me acquire them, I'll keep doing it. If it wants to let me continue to allow that doing that, I will do it. You know, let me own half the float. That's fine, but really, it's not about that for me. It's not about that at all. It's more about wanting to limit the risk of future buys. Let's think about it. You guys ever buy a stock? You see it fall? You start freaking out, you sell it. Next couple days, it's up. You don't think I do that? GST, my stop got hit yesterday. My stop got hit in GST. I don't have free shares in GST. If I had free shares, do you think I would have had a stop at $4.14? No. If I had free shares, my stop probably would have been that 50 moving average. But I didn't have free shares. And it was up, even that stop was still a 5% gain from where I'd bought. John, I'm already retired. I'm a combat disabled veteran. I get $3,900 a month tax-free from Uncle Sam. But believe it or not, a lot of you guys know this. I'm 31 with 3 any day now. Why? 31 years old. Honestly, why? I've been asked this before. Why do I, you know, if I'm trading, why do I run a chat room and why do I do that? Honestly, it keeps me busy. It gives me a purpose in life. It's not even about the fun thing, which I do have. But let's think about it. I've known somebody, they, uh, they worked all their life. Once they retire, they just start this slow slump until they die. Yeah. At 31, I don't want to do that. A lot of people kind of find a purpose in life through what they do. You know, their job, their career. Well, I'll share some advice. And not to brag, but being pretty damn good at it too. But, you know, it gets pretty boring just sitting watching the computer all day. The chat room, hey, that adds another element where you get to communicate with people, where you get to kind of have fun in your day. That's why I do that. But like GST, for example, had I been on free shares, I wouldn't have been selling where I sold, but I wasn't on free shares. Why? When I bought down here, because I got ticked off, I sold here. And then I missed this entire run. So I let emotions get the better of me. When in reality, I should have been on free shares with GST a long time ago. Why do I say that? You see those green arrows there? Those are buy alerts I made on GST in this chat room or the other chat room I was at. Had I followed my own trading rules, I would have been on a long time ago on GST. So, let's sum everything up. You go long on a position as a chart makes higher lows. Convert to free shares to limit the risk of future buys. Why do I say that way and not just to build a big, huge nest egg? All relate to that if we make money on a chart, we usually like to go back to that chart and trade it again. And sometimes we force trades and then we lose money and then we make money and then we lose money. But when we make money trading a chart, we like to go back to it. So if you already know what basic human nature is going to force you to do, which would be to constantly revisit charts you've made money on, having free shares in those charts will allow you to have limited risk on future buys. We also talked tonight about options trading, a couple different ways to swing options trades. We've talked about longer term, 4 to 6 month, playing in the money. And then we talked about shorter term with playing an average time between the past few runs plus a couple weeks in trading something that will be in the money within the trade plan.